Good afternoon and welcome to the LIONTRUST Asset Management PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Simon Hildrey, Chief Marketing Officer, Vinay Abrol, CFO, and John Irons, CEO. Good afternoon to you.
Afternoon.
Good afternoon. Yeah. My name is John Irons. I'm Chief Executive of LIONTRUST and have been so since for the last 13 years. I'd like to thank you all for giving us this time to present to you on the opportunity set that for LIONTRUST. This is obviously on the back of our financial results, which Vinny will go through in a moment. I'd probably just like to sort of start by, an introduction to LIONTRUST. I no intention of talking to the points on those slides, but you can see where the business is now. When I joined around 13 years ago, the business was £1 billion of assets under management and has now grown, as you can see, successfully to 33.5 billion of assets under management. The strategy has been one of, and I suppose my experiences over the last 35 years in fund management, and the opportunity set when I started in LIONTRUST was to look at, what's good about that business and what can we do with this industry. And if we look at the whole savings industry in general, and you look at the move from defined benefit to defined contribution, what is the key factor that has come out of that? Defined benefit, final salary schemes were always linked to your length of service and your contributions into a product. The shift to defined contribution and the sort of moves that were made along that time were that the individual took ownership of their investments. And from my point of view, that was the most important point. This is an industry that's grown up on telling people what they need to invest in, how they need to invest for the future, and what they should do. And I think what we've seen over the last 10 or 15 years, and certainly in the development over the last 5 years and through the pandemic, is the individual taking control of their own savings. After all, that's why you're all on this call. So what we tried to do, or what we have done, is put the client very much at the center of what we do. We explain the process of how we manage money. So if you look down, you will see that we don't have a chief investment officer at LIONTRUST. Why do we not have that? If you look at the big investment houses, where you look at compliance, you look at risk, and you have a chief investment officer. In fact, some have several chief investment officers. You're looking at how do we mitigate risk, and therefore how do we stifle the individual's ability to manage money? On the other side, what you don't want as an investor is you do not want a fund manager to be able to play, for better words, fast and loose on what they're doing with long-term savings. These are savings that we are the guardian of, that have taken people 30, 40 years to accumulate. So what we look at LIONTRUST is how do we attract the best talent? How do we create an environment for them to run money the way that they want to run that money? Right? So it's very much about process. We will create that environment where all you do is focus on that process. And not only do we that internally, we use external people to coach on the fund management side to say, how do no fund manager gets every decision right, but how do we improve the probability that the next decision we make has more chance of being right than anything else? And if you think about it, if you look at professional athletes or in sport, fund management, is no different, but you need to be able to create the framework by which people can be consistent in those outcomes. So that's what we do. That's why it enables us to attract people. We've 7 teams across that. So by no means do we mean to have the answers for all investment strategies, but the areas where we think we can add value as active fund managers are the areas that we will focus on. The other side of that equation is, if you do that, we provide a route to market for what you do. And in terms of communication and delivery and understanding. And those are all areas that in an industry that often uses jargon to make it very opaque, lacks transparency. If you think about it, there are hardly many industries where everybody of a working age in the UK has a pension. If you look at that relative to any other industry, the level of trust within the industry is very poor. So what we're looking to do is explain to people what we're doing. The present climate is no exception to that, where you've got an awful lot of short-term noise going around and volatility, uncertainty about the future. The one thing that you want out of your investment team is not to be chasing short-term gains. You need people to be looking at, other companies that we invest in, are we investing in them for the same reasons that we invested in them last year? And if I look at markets now, and we look at falls, are those companies half as good as they were a year ago, or were they twice as good a year ago? So to have that anchor, to have that focus, and to have that confidence in being able to manage money. We're managing money for people's long-term savings. People's savings are 5, 10, 20 years out. What you don't want is people, taking short-term decisions because they think something looks cheap on a short-term basis. So with the fund management side, that's key to us. With the distribution side, being able to communicate on process and to sell on that, and to engage with our client base as to how we forward those are the 2 base tenets of that business. If we get that right, and we're disciplined in the way that we run the business, the results will come through. If we go through, if you look at the rise of the business there, that is very much, I often think when I talk to shareholders, I do shareholder presentations, it would be much easier to say, if I was at Apple, I would have a new innovation, I would have a new product coming out on a regular basis. What do? We do the same in 2011 as we do today. How do we get the edge? How have we grown to be a group that in terms of inflows, was second in the industry last year in terms of net flows, is regularly in the top 10 in terms of gross flows. There's no secret sauce. There's nothing magic to that. It's very much about, if we do the day job, day in, day out, that will give us the advantage, because that itself is quite hard to do. That's why process fits through what we do on fund management, what we do on sales, what we do on marketing. And so, the strategy for growth has always been based on a 3-pronged approach. Organic growth is what Vinny and I and our management team focus on a day-to-day basis. That's what we can affect on that day-to-day basis. The other 2 areas are talent hire or acquisitions. Talent hire is where we would bring in a new team or a new fund management discipline or skill set. The issue you always have with that is that it takes 3 years to get a 3-year track record, or you have to get a critical mass in that asset class to start with to engage with your larger clients. So That brings in the third opportunity, which is acquisitions. If we look at acquisitions, buying assets just to fill up silos is not a very profitable way to run your business. The financial services industry is littered with examples of people who have bought businesses on the basis of, if I take 100 million of costs out, I put a 10 multiple on it, I've created £1 billion worth of market value. That in the short term may work. The problem with that is if you haven't got a product that is focused and delivers to the end investor what they require, you will just see the slow attrition of assets over the next 2, 3, or 5 years. What we've tried to do through our acquisition policy, through Majedi, the more recent one, Architas, Neptune, and back 5 years to LIONTRUST, is to say, what are we looking for with this business? How can we grow it? We're looking to grow it by either adding to our manufacturing, our investment management skill set, or our distribution skill set. And if I can do that, if I can use acquisitions to give me a distribution or a manufacturing benefit, it fast forwards that grow your own development. And if I look down the line, you see with LIONTRUST, that was a business we bought in April 2017. It was a business that was probably 2 years in the making of discussions with me and our previous chief executive as we could go there. It was an area that we'd want to invest in on the sustainable side. It's an area where the brand awareness now of LIONTRUST is in the retail market the strongest in sustainable. It has been responsible for strong inflows into the business. When we bought them at 2.5 billion, and they've moved forward to 30.2 billion. When we bought them, they had a 16-year very successful track record. That's continued over the next 5 years. and apart from in the short term, where performance looks weaker because of the exclusion of sort of energy or carbon emitting stocks in their portfolios, at a time where you've got, I would say unprecedented, but it's not necessarily unprecedented, but terrible events in the Ukraine and the squeeze on energy prices, you're going to look weaker when there's a short-term scramble for demand. On the other side of that, if you look at sources of alternative energy and moving forward, there's probably been no more one event that has focused people's attention on that. The lack of opportunity to provide short-term replacements does not take away the opportunity set of where the direction of travel is. And I think that's back to having strengthened your convictions, the investment process, and the focus on that, and to be able to create an environment where fund managers are not being, affected by, short-term noise or headlines. So, from there, with Neptune, that was a deal that broadened out our manufacturing base, gave us much more global product, and where areas of demand and client base. Architas was a business we bought from AXA, the French insurance company. It bolstered out our multi-asset offering. It also bolstered out the level of service we could provide to the intermediary market in the UK, where they are increasingly, from a regulatory point of view, moving away from managing assets themselves to looking at risk-rated portfolios that they can provide to clients and the support they can get from that. More recently, the Majedi acquisition was one of LIONTRUST's core business and strengths has been to build a very strong and successful brand in retail in the UK. We've been years awarded Fund Manager of the Year in that retail space. to Investment Week. And what we looked at was, how do we develop the business into other distribution opportunities? In my role, there are no lack of opportunities to grow the business. But what I have to look at and to balance is, where are we capable of growing and how do we do that? And after the people in the business, the most important asset we have is time. How do I allocate that time across the different resources inside of the business and the different routes to market, whatever a better word, because obviously I have the opportunity cost of where do I take that resource away from. So to be able to enhance the distribution, that we're a small institutional business, it had recently won one of the local authority, amalgamate the local authority pension funds, but with the acquisition of McJady, that brought to us an awful lot more of the plumbing for in terms of how you get out to not only the consultants, but an existing client book of business. And so that, to me, rounded off or enhanced what we had there and set a very good foundation and platform to go forward from. So acquisitions get headlines, but they've got to be to a strategic benefit to the business. Size is not, the result. You've got to come out the other side of that with something that is useful and provides you with focus. If I, move on to, slide 9, but I suppose this is one of the, benefits, but also the distractions of the moves that we've all made to, Teams or digital presentations. A financial services industry that, has found it very difficult to engage with a very broad base of clients has been, I suppose, moved forward rapidly, in the last 2 or 3 years, predominantly forced by, the pandemic and our ability to do that. But believe you me, to talk to a screen and not to be able to get recognition back from the client base, is a much, much harder thing to do. So if we go through, I will take it as read 9 and 10, because, you're much better at reading things than I am pointing things out. And so if I look at where our business sits now in terms of our assets, we're a very strong brand in sustainable, probably number one brand there in the retail marketplace. It's very, key and core part, of our business. And I think in that broader responsible capitalism is how do we move forward. If I go back through my career 10 years ago, well, maybe even only 5 years ago, the questions on sustainability were all at the back of any client meeting. They're now the first questions that you get. It is an area where there is a lot of noise. Data sets are inconsistent. Levels of knowledge are poor. But they will improve rapidly over the next 3 or 5 years. And I think if you ask any client, and this is very much part of that transition from defined benefit to defined contribution. If you ask any client how they would like their money, or would they like their money invested in a more responsible, sustainable way, the answer is going to be yes. That's definitely what we found. I think now with a lot of noise, and you get it from, HSBC making comments in Miami to which have been raided in Germany. The regulator, the FCA in the UK, yesterday saying everything needs to be more evidence-based. For me, that is perfect, because the most overused phrase probably in the industry now is this is embedded. And if it becomes evidence-based, you're going to have to be able to demonstrate that and to show it. And if I talk to our institutional clients, they're saying they want to allocate money, they're being driven to allocate money, but there are a lack of appropriate products to be able to do that. So I think if you can demonstrate and not just pay lip service, it's a huge growth area for the marketplace. The other products there is we have a very strong franchise under economic advantage, in excess of 20 years of great UK equity across mid, small, large, and micro cap funds. An enviable track record there, and that is an area where if I'd said to you 3 years ago, people have the lowest UK equity weightings, I'd have been wrong. People have continued to do that. But what we find there is that the sale on process, the ability of clients to understand where we're looking and what we're investing in that quality growth sector of the marketplace, it is about providing products that are the most suitable for them or what they want in that space. And I suppose it's a little strength at the moment, but having done a few client meetings over the last month, when I talk to people about what's going on, then turn around and say, you're the least of our problems in that place. Now that's not a strength, but what they know is what they bought us for. What they know is what we'll adhere to and stick to, and that fills the requirement within portfolios for clients. So that is very much the badge of LIONTRUST in terms of we will stick to what we know we're good at. We won't deviate away from that. In the short term, that may look performance-wise weaker, but in the long term, as our results show, that's what we know is right. If I go back through my career, this is not too dissimilar to 2001, to where it was called the dash to trash at that stage. Now, it's not to say that market sentiment is the same now, but to throw the baby out with the bathwater and to move forward is not what you want your fund managers doing. So, there's a lot of importance from my point of view on giving the fund managers the confidence and the freedom to stick to what they're doing and the support whilst running all the checks and balances across that. Slides 13, 14, 15 say where we are with things, as do the next ones. You're capable or more than capable of running that. So if I hand over to Vinay now at the start of 19.
Hi there. Okay. Thanks everyone for joining us for the this presentation. So I'll maybe spend just a few minutes going through our financial results and the highlights. The strap line there show that we're demonstrating a profitable and growing business, and maybe I'll come back to that in a moment actually, because there's another slide that shows how we've done over the years. But what you can see here are the key metrics for our financial year just ended at the end of March. So we've grown our gross profit or revenues in old language up 41%. And that includes an element of performance fees. And if you take performance fees out, we've grown the underlying revenue of the business by 46% over the course of the year, where our average AUM is up 43%. So we've shown that we've been able to grow our revenues faster than we've grown our average AUM over that period. That's translated into an adjusted profit, and we use adjusted profit to give you an indication of the underlying profitability of the business, stripping out some of the charges that have related to acquisitions, which vary year on year. The adjusted profit was up 64% at £96.6 million. So again, up 64%. And I think what that shows you, that in a well-run business, you should be able to grow your profits faster than your revenues, and that's what we've been able to do. Our EPS, our adjusted diluted EPS, it shows you on a per share basis the profitability after tax, again up 59%, slightly less than the adjusted profit number, but that reflects the number of shares that are in issue. And that financial performance has resulted in us being able to increase our dividend by 53%. So to 72p, we've just got ex-dividend 50p second interim dividend today. Yeah. So what you see there, you see a business that is performing well. We're growing our revenues, we're growing our profits faster than our revenues. Our costs, see on the next page, our other costs, other admin costs around the business are up 26%. So we've got good cost controls, and that financial performance has translated into increased dividends. So shareholders are benefiting for a substantial increase in our dividend for the full year. The next slide just shows you some of those numbers again, a bit more detail on the metrics. Another key metric I'd just like to highlight: adjusted operating margin. Now, operating margin is how much of your revenue is coming to the bottom line in profit. So it's a good way for investors to look at a business and see, what is dropping down to the bottom line. And you've seen with us a progressive increase in our adjusted operating margin. So it shows you that our business, as we grow, is running more efficiently. And it's one of those things, sometimes people talk about operating leverage. So, the more revenues you have, the more profit you should make, because you shouldn't need to increase your costs in line with your revenues. And that's definitely the case with LIONTRUST. And there's another slide that will show you that in a bit more detail. Another really important metric on this slide are our average revenue margin. So are we getting this extra revenue by slashing our prices to get extra assets on board, more revenue? But we're actually sort of killing ourselves on our revenue margin. So you can see here, last year our revenue margin was 0.62%, 62 basis points. So that is effectively how much of the funds we manage, what are we earning in revenues? Last year just gone, it was slightly higher at 63%. So it shows you again that we are increasing our AUM, but we're not cutting prices. We're being able to maintain our management fee on the products that we run. Some of this is mix related. We have products across a wide range of areas. John touched on the various investment teams earlier, and each of them have different margin rates. So some of that, sometimes that affects that, but it shows that we are able to maintain our margin in what is actually a very, very tough business for fees. The next slide, unfortunately, is a lot of numbers, but it shows you, and it's quite an important slide actually, because it shows you the progress of LIONTRUST, and at the top, we're highlighting the acquisitions that we've done over the years, and it comes back to that strap line on the previous slide, where we can demonstrate here that we are a profitable business that's growing consistently, and you can see and this goes back to 2013, so nearly 10 years. You've seen that we've grown our AUM, assets under management, or recharge revenues, from 3 billion in 2013 to 33.5 billion at the end of the last financial year, which became 38.7 with the Majetti acquisition. So you've seen consistent AUM growth over that period of time. And you can also see that that's translated into consistent growth in revenues. So the revenue sometimes is out of kilter with the AUM growth because of the way the averages work. But you can see that we've delivered that with the AUM. We've delivered revenue growth, and in turn, that revenue growth has delivered growth in profits. So we've been able to translate that revenue growth into profit into dividends. And you can see, it's only 9 years ago that our dividend was 1 pence a share, and we've just paid out 72 pence a share. So you've seen that our shareholders have benefited from that growth in AUM, revenues, and profit. Operating margin, I touched on operating margin before. Again, you can see that consistent growth in operating margin. We're operating now, as we've grown into the into the 30 billion level and profits close to 100 million, we've grown into an operating margin of just over 40%. So I'll maybe go on to the next slide. I think the next slide, we've got some key metrics in AUM. So maybe I'll just, I think John's covered most of these points on the team side of things. The interesting slide here, the chart on the left shows you, LIONTRUST is predominantly a UK retail business. So if you take the UK retail line of 64% and the multi-asset at 71, over 80% of our business is effectively sourced through the UK retail channel. But we have a substantial amount of AUM in institutional, just under 5 billion, and that's been boosted by the Magelli acquisition, and a small amount, just around 6% in international assets, which are managed out of London, but are sold into Europe. Client type, again, very much influenced by our focus on UK retail. Again, the majority of our client base is through that intermediary wealth management space. That chart is excluding Magelli. When we have Magelli on board, that will take us into a more a more institutional type basis. I think John's already gone through the teams actually, so I won't dwell on that. And then you've got another slide here which just shows you, drills down into LIONTRUST as a business. Where is the AUM that we manage? 5 years ago, our business was all 100% UK assets, 100% equities, and you see what we've done through the acquisitions that John's talked about earlier. We built a much more diverse fund management business. We now have 60% of our AUM in the UK, a substantial amount in America, Asia, and Europe. We have 74% of our AUM in equities. So again, we're not only much more diversified by region, but also much more diversified across asset classes. So what you're getting with LIONTRUST is actually a more diverse business than it was 5 years ago, and that is a key strategic aim for us to have more diversification in our business. The next slide just shows you again our AUM in a tree burst type approach, and what it shows you is that especially in our funds, multi-asset is actually is a group of funds. Actually, we have a broad range of funds. Our largest fund is a special situations fund, which is just around that £5 billion mark. But if you look at sustainable investing, a broad range of large funds. So it shows again that point that we are a diversified asset manager. And maybe we'll finish the presentation with a little bit on outlook.
Pick up on those points that none of them will be new to anybody who's looking to invest in a sector. We have a savings crisis forward. People now have an ability, or own it. People have taken the shift from DBDC. People have taken ownership. Sustainability, is a big part of that. Next generation of investors, but I tell you from our own, research and feedback, we know that if I talk to you about the shape of the yield curve, most people will switch off. If I talk to you about a transition for cleaner, greener energy, decarbonisation, social inequality, I've found a medium by which I can invest with this much broader base of investors now. Something that people, are passionate about and care about. So I think for an industry that historically has done itself no favours by making itself impenetrable, I've referred to it in the past. I am Catholic, so it's a bit like Catholicism, where you use Latin to become highbrow. You've got to find a language which you can build trust with. Trust is not great across the industry. So to be able to explain to clients what's going on and where they are is massively important. The M&A side is the bit that everybody focuses on. There are several, questions that I could see, for example, in the chat side there. This is an industry that hasn't executed M&A particularly well. But if you put two businesses together to and take costs out of them, and you put a multiple on that makes the business look fine, that's all very well and good. But if you come out of there without any focus or strength or a stronger proposition, it doesn't work. I think where we've been different, or where we've maybe not even different, but what we try to focus on is what are we buying, what do we want to achieve. In any acquisition, day one, we have already made the decisions that we want to make about the structure of that business and the way it's going to go forward. They may not be right, but in business you get there are three types of decision: good decision, bad decision. Neither of which will, one obviously is great, one won't kill you. Indecision is the one that generally does. So you've got to have a clear focus of what you want to do, where you want to be. And even if you've made a bad decision, you've got to be able to address that and look at how do we improve it going forward. So that helps you get that focus going forward. There are several opportunities around the market now, but if I look at them from LIONTRUST's point of view, and I look at them over the 13 years that I've been here, what's the difference? The bar is definitely higher now. 18 years ago, you can only execute the deals that you're capable of being able to execute. Fortuitously now maybe in a position where we can we've got backing on strength and demonstrated from our track record to be able to do things. But just because you can execute something is not the reason for doing it. The things that add value are the organic growth and the focus of the business. Acquisitions should be used purely to take you into new sets and to move forward. And then you've got to balance the resources of the business against that as to do it. So whilst acquisitions will grab headlines, they may not always grab you the best results. I think where we are now, broadening out our distribution capability, the move more towards institutional will allow us to broaden out our product suite. More longer-term, limited liquidity product that may not sit well in a retail marketplace would sit well in the institutional side. So that will help us aid us with our development there. I think, very much as we went into the pandemic, I said internally at the time with the shareholders, where markets go, where flows are, I can't affect. But what I can affect is when we come out of it, on the other side, do we have a stronger market share? And that, the ethos here is very much about doing the day job, day in, day out, as best we can. That's what we can control. And that's what we know will give us a competitive advantage because we maintain the highest standards inside our own business. We know that will take us forward. I think on that point.
And back to investor meeting.
Questions.
John, Vinay, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated on the top right of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. Simon, could I just ask you to read out the questions to the team and where it's appropriate to do so, and then I'll pick up from you at the end.
Yeah, thank you very much, and thank you to everyone for submitting your questions. There are two or three that kind of pick up on your last points, John. Maybe just on that acquisitions, do you expect further consolidation, and how competitive is that acquisition in the industry?
People have talked about consolidation for best part of 30 years. I mean, it does happen. Things happen. It happens either at the top where it becomes a size. I think, if I go back 10, 15 years, you could argue that the larger you got, the more able you were to offer a lower cost solution. So if you're running 25, 50 billion in a market strategy, could you cut my lunch and offer that service cheaper? Now, we've always been very, firm on price. We've probably turned more money, or considerable amount of money away, where people have said, we'd like to give you a lot of money, but we would like a cheaper price. Now, your ability to outperform is a function of capacity in that marketplace, and to be able to deploy those assets and take advantage of that. The problem you get with when you get bigger and bigger is that your ability to take advantage of that, you from a regulatory or compliance point of view, you're drawn more and more back towards the index. And if you're wanting to be an active manager, but you're drawn more towards the index, over the last 10 years with the index providers coming out who are running money for 4, 5, 6 basis points, they've cut your lunch. So we very much focus on the areas that we can add value. We stand or fall on our ability to be able to add value to client portfolios going forward. So acquisitions just to bolster size, don't really work, or certainly don't, enable you to grow your business going forward. Acquisitions for skill sets are different, and I think we will continue to look at that. We're fortunate that we see pretty much every deal that comes across, and where people will approach us to say, "Would you be interested?" But that doesn't necessarily mean we should do anything about that. It's only in the areas where we see that. I think otherwise you end up it's like two drunks at the bar propping themselves up. It doesn't work, and there are plenty of examples over the last 3 or 4 years of that.
And just on the institutional market, you talked about, obviously, with the Majedi acquisition. As the geographic split, is that different for the institutional market? I mean, is it more global?
It is in a way, and Majedi have a global presence, but definitely were more known for their sort of UK equity. I mean, recently they won one of the oldest and largest investment trusts in Edinburgh Investment Trust, and since they took that on board just over 2 years ago, and it produced very strong returns there. But also, if I go back to the sustainability, or in its broader sense, sort of responsible capitalism theme, I think to be able to demonstrate that in the institutional marketplace is definitely a position of strength. If I talk to consultants, or I talk to institutions, local authorities, we've just been one of the managers appointed to one of the local authority sustainable mandates. They've been awarded LPS, which, but a note, the fund itself is about $1 billion. We're one of the managers there. But the feedback is very much, we're looking for sustainable solutions. Around the world, we've got sovereigns, governments dictating that they would like more money invested in that way. And one of the barriers is, people are looking at it and saying, well, there's a lack of appropriate or accessible product, or managers are doing that. And it's not about paying lip service, it's about being able to demonstrate what you're doing and to prove that. So I think going forward, that's a great area of sort of potential competitive advantage for us.
And does it diversify client base internationally as well? The institution, could that potentially grow up?
Yeah, I mean, the opportunity sets to grow. I was in Paris yesterday talking to a European institution about what do they want, what do they need. This is a group that we have a distribution agreement in place with. And sustainability is top of their list. Understanding process, that regulatory side. Not surprisingly, they are very much focused on how do you evidence what you're doing on the sustainable side, the regulatory risk for them, and for institutions and pensions in that space is large. So it broadens out. But again, back to the point I made a couple of times, it's about it's not the shortage of opportunities. It's focusing on the opportunities you can get the best outcomes out of. Sometimes walking away from something because you haven't got the bandwidth or the time to invest in it, until you do, is a better outcome for the rest of the business.
And Vinay, I just want, somebody's asked about the fall in the shares. Would we consider buying our own shares?
No, I mean the board does regularly consider where the share price and share back and possibly buying back shares. We take out an authority every year that allows us to buy up to 10% of our shares back. So we've got that ability to do so. We've got the permission to do so. But we have been conscious, even as we are a mid cap now. We're at the smaller end of the mid cap size. We're wary of sucking liquidity out of the markets. So although it's been considered, we felt actually the increase in the dividend is a great way to return cash to shareholders. But it is something the board does keep under regular review.
We do look at it, but it's we want to get more investors. To get more investors, you need liquidity. If you look at us relative to other financial stocks of the same size, there's probably more volume or trading and ability in that. If we take liquidity out, one of the questions you could ask is, how easy is it for me to buy X, but also how easy is it for me to sell X if I held X? So you will know this. As investors, liquidity plays an important part in your decision. So for us to take liquidity out of the market with the size we are, I don't think it's appropriate. And also, surely, rather than just buying and selling shares through Treasury, I should be spending my time trying to work out how we grow the business going forward.
There's a question about our EM going up since the end of the financial year. Do you want to explain that very quickly?
No. So our 31st of March number was 33.5 billion, and we announced on the 17th, with our results, 17th of June, AUM was 34.2. But what we did, the market has come down significantly since then. It's not inflow related. It's just that we completed the Majetti acquisition on the 1st of April. So Majetti took our AUM actually to 38.7 billion. So what you've seen over that 2.5 month period is the AUM not increase from 33.5 to 34.2, but decrease from 38.7 to 34.2, which is mostly driven by the markets.
And final question, we've been asked if we would ever cap the size of our funds for performance reasons. A question I get asked quite a lot. We continually monitor funds, and certainly the smaller ones. So really, we're only talking about funds where we've got a very good, strong track record in like small cap, where obviously there's a limited liquidity to ability. I explained earlier that if you've got very large funds, how do you deviate away from the index? How do you add value? How do you add alpha? So we do that. And of course, the other side of that is that do you soft close, do you hard close funds?
prevent investors coming in and out of it. If you soft close a fund, all you're doing is preventing anybody who hasn't bought it buying it in the future. So that doesn't really change anything, because your existing investors could continue to buy it. If you hard close it, and you have a client for whatever reason decides they want to move money away, or reallocate to another area, you're then left with going back to clients saying, the fund that you wanted to buy that I wouldn't let you buy before, but now you can, is not really a good sort of sales or customer service message. So what we look at is size of those funds, and we like to think, the position we've got with the strength of the brand and the distribution is we know our clients very well. So if we think a fund is at that point, we would, explain to clients that we don't think that's there. There's the other advantage of that. If we've done that from a regulatory point of view, it would be very difficult for the individual or the company to buy it. But I don't think it's a kind of black and white thing where it is. Ultimately, at the end of the day, if we thought it was going to be detrimental and we could not control it, yes, we would look at a vehicle like that. But we'd like to make, we spend a lot of time building relationships with clients. We'd like to think that because of the way we sell on process and communication, we have contact with our clients. And it is not just because, the funds are great performers and people buy them and, we have no control of it.
Okay, thank you very much.
John, Vinay, Simon, thank you very much for updating investors today.
Okay.
Could I please ask
Okay.
investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of LionTrust Asset Management PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you very much.
Thanks a lot.
Thank you.
Thanks, everyone. Bye.